Welcome to the latest edition of Market Monday on a Tuesday, brought to you by the investment team at the Trust Department at the First National Bank. Wow, a lot happened over the weekend. We kind of had to digest it before we came out with some commentary, see what's going on in the world in terms of market activity, interest rates, etc., before coming out and kind of giving a lay of the land, at least from our view. Normally we start these with a review of the economic data that's coming, and this stuff over the next couple of weeks is going to be somewhat important, but it takes on a much reduced impact relative to the geopolitical events going on, which is where we're going to focus a little bit more on in terms of being a catalyst for moves in the markets, some of which are rather sharp. But over the next couple of weeks, we're going to get information about outlook, the Purchasing Managers Index. We're going to get information about demand, new orders, etc., prices. These are the real things we want to watch. Productivity and price information and retail sales information, labor market information. We're concerned with this stuff because the economy has been running relatively hot comparatively to what the widespread thesis is. And, we're kind of perplexed as to why the talking heads out there are poo-pooing the idea that the economy has been running relatively strongly lately by historical standards, and that inflation, in fact, has become pretty truculent and stuck. And instead, they're talking about this return to normality. With recent events as a catalyst to push things even higher, because wars tend to be catalysts for economic growth as defense industries are pumped full of capital, manufacturing, etc. So, with an already inflationary condition and an already somewhat hot economy, albeit, maybe decelerating a bit in the last quarter of last year, overall the economy seems robust, and yet they've been cutting rates, which we don't entirely agree with here on my team. But with that said, let's go in and look at some of these factors in a little bit more granular detail. So here is the quarter-and-quarter GDP. And basically, the fourth quarter number came in at 1.4. However, the number for Q3 was 4.4. So, we've taken a different approach than looking at this relatively noisy number. It moves. Obviously, you can see on this chart, it moves up and down quite frequently. But taking a moving average of the past 8 quarters, we're still at 2.2, which is hotter than the 2% that the economy is sustainably able to grow, and certainly is a sweet spot, close enough to where they really don't need to be cutting rates. It's not below 2. It was for a blip, but not durably so yet. And the labor market seems strong. So this says the economy is at least strong enough to hold its own in historical standards. I would argue that this latest 1.4 in Q4 is going to get revised up come the next revision, but we'll see what happens. The core PCE index is the Personal Consumption and Expenditures Index, which is looked at by the Federal Reserve when they're talking about what to do with interest rates at their meeting and then coming out with their pronouncement. Now, this goes back into history, and we are squarely in conditions geopolitically that resemble this period here, late 70s, early 80s. You've got great power competition. The great game is afoot. We're at war with Iran. We have, shaky alliances with Europe. It's not good with China, really. It's not good with Russia. Everyone's playing for themselves now. It's not this era of globalization that supported lower prices. And lo and behold, we're up at 3% in this, basically 2.99 and change. And that's the Fed's preferred indicator for measuring inflation, well over the PCI or the CPI, and the PPI, which is the Consumer Price Index and the Producer Price Index. Both of those are relatively strong as well, although they do argue that corporate margin might be okay, not terrible at the moment, and maybe even increasing because consumer prices happen to be going up a little bit quicker or with more velocity than producer input costs are. Looking at the forecast for GDP, Q1 is forecast by consensus to be 3.2% in GDP growth. That is well above the 2.0 sustainable long-term growth rate, and 2.8 for 26 Q2. 2.2 for 26 Q3, and 2.1. So economists seem to expect a decelerating economy, and we don't really see that. Let's jump into markets. What has been going on? Well, this is the VIX Volatility Index, and it tends to spike whenever there are major events going on, and when it spikes, it can spike very sharply. So over the last year, we had a big scare, last spring, and we've had a couple in the fall. Anytime this index is over 20, it's considered to be quote-unquote interesting in markets. And so we're seeing that, that essentially says volatility expectations over the next 30 days are for roughly, I would say, 1.5 to 1 2/3% up and down daily moves in the market are what the expectations are with that number right there. And if there are significant developments in this war, let's say new entrants into the combat, say alliances start to step up on sides, and this becomes more than just a regional war, and this becomes, great power face-to-face warfare, this number will spike and it will get kind of turbulent. The S&P has been holding remarkably well. Average true range here is relatively constant, so we haven't seen a major impact yet in U.S. stocks, although it has been relatively choppy, and we have been seeing that predicted level of volatility that we just spoke about here on the VIX. This is a big driver, crude oil, and this is the front month futures contract in crude oil, which was already arguably on a pretty robust uptrend anyway prior to the events last Friday. It would already been up about 21%, and over the weekend we had an enormous spike, another 13% higher, which when you compound that comes out to close to 39% higher than the recent low, which was in December, down, at 55. We're trading at 76 and change right now in the pre-market, and this is Tuesday, the 3rd. So this is the type of chart you really don't want to see, particularly here with this average true range going from $2 a barrel up to $5 a barrel. That says the difference between the high and the low has gotten remarkably bigger. There's a lot less certainty in this market. And if we had to call it, because they've closed the Straits of Hormuz, at least ships are avoiding it. Iran has come out and said that they're going to blow up anything that goes through there, with arguably, they probably lack the ability to do that at this point, but the threats there and shipping lanes are closing down. There will be an impact on the cost to insure cargo through that area, potentially worldwide, because of the combat might not be limited to conventional means. There might be terrorist incidents that happen elsewhere. The regime in Iran has proven that it's willing to do those types of things. So shipping is taking a bit of a hit in terms of the cost to move goods, and certainly 20% of the world's oil comes through the Straits of Hormuz. However, the last time we had a major oil shock here in the States, we were in a much less strong position. Now we're actually a larger producer of our own oil, and as a result, we don't expect prices here. This is West Texas Intermediary crude. We don't expect prices to go as high as some other areas of the world where they're using Brent crude, for instance, which is trading much higher because it theoretically, is passing through that region. And, we just have to take a wait and see approach as to how the energy markets are going to move. But energy is going to be a big winner along with industrials in this type of a marketplace. Gold as well. This one's kind of hanging out. It came up initially opening up yesterday and has been trickling back down. So not really as much of a safe haven. Here is the most interesting, at least in my opinion, thing that's happened. We've overlaid the Treasury curve from Friday's close with the current one today. As you can see, yields have spiked. And this is highly unusual because in times of uncertainty, the quote-unquote flight to quality trade is to buy treasuries, which would have the effect of lowering yields. However, because treasuries are priced based on inflation expectations, we can conclusively say that the large players out there view this war as highly inflationary. When you look at basically 5-year paper, which has moved 18 basis points higher in yield, and outward further on the curve it's a little less pronounced, but that is an enormous move in a few days in these markets, and so what it suggests is the risk of inflation is a lot higher, and currently potentially in the money markets we're going to see more of this. We're going to see in the treasury market the yield curve probably continue to advance, particularly when in the next few weeks we have some inflation numbers come out. If those numbers are hot, expect the yield curve to rise in treasuries and the value of all bonds really to fall somewhat. In terms of what happens with oil, that's also going to be a lever. What happens with the equity markets is dependent kind of on oil, because oil and energy are a large input cost to corporate balance sheet or corporate income statements. So when we're looking at what's the overall implications of this, it increases risks of a downdraft in the market. And March has a dubious distinction of being a time where markets can be more prone to volatility than other times in the year. So we want to watch what's happening pretty carefully. We want to play a defensive game in the markets, but we also don't want to get spooked. Longer term, let's zoom out here and let's go 20 years. So pulling that up, we've seen a lot of really crazy things happen over 20 years. We saw the 2008-2009 financial crisis. We saw COVID. We saw a full-blown bear market in 2022 and a serious pullback last year. And we're still trading near highs. And if you're taking the long view, you've done really well to just stay the course, and that's what we intend to do. However, the new environment that we're in suggests that lower index returns are likely in U.S. large cap domestic stocks. And as a result, we've been moving into some smaller capitalizations and seeing opportunities globally, at least in developed markets. That's probably what's going to work going forward. And make no mistake, if the index return in the S&P, which is widely forecast to be somewhere between 7 and 9%, by the analysts out there on the street, and that's for a long period of time. Just because the index return is expected to be lower, we expect dispersion around that average return to be much, much higher because of these challenging conditions with inflation. And companies are really going to have to get their finance team correct in terms of strategy, and they're going to have their marketing and their sales on point to survive and thrive in this environment where prices are elevated, economic growth is robust, but incomes are not necessarily keeping up. So eventually, you're going to see a much wider array of big winners and big losers within that average return, and it favors being a little bit more active in your approach to investments. This is the corporate yield curve, and this is where I'll close. These yields have not gone up by as much over the past couple of days, indicating that the effect is much more geopolitical than expected to spill meaningfully over in increased risk in the corporate world. So we like to see this, and we don't mind seeing nearly 5% on 10-year paper and certainly above 4% on 5 years and out. That's healthy for the fixed income portion of your portfolio. And closing thought, over the past few years, you've heard a lot of the pundits talk about how the quote-unquote 60-40 portfolio is dead, meaning 60% stocks, 40% bonds, and that way you diversify your risks and you have the stability of bonds that lowers the overall portfolio volatility of your stock holdings. And they said this is not a good trade. Actually, this is exactly the type of portfolio you want. This is exactly the type of diversification that you want in most cases. Please don't take that as individual advice. In broad terms, that's what we're saying. You would actually have to talk to your advisor to determine if that's actually the right move for you. But in any case, if you find the video useful, hope you did. If you have questions about your portfolio or the markets, what's going on and how the impact is going to be on your investment plan, by all means, reach out to us here. We love to talk about it. Thanks. Have a great day.